Really excited about this session. Henry's especially excited. He's got his special shirt on. We're delighted to have Ashok Gupta and Will Hutton on, and Henry will explain all. As usual, I'll monitor the lobby. If you want to ask any questions, raise a hand. If you want to put any links or any comments in the chat, please do. And we're hoping that, thank you, Henry. And we're hoping we should be finished by 11:30. We are recording, so thumbs up, everybody. Happy to be recorded. Clive, Bob, John, Terry, everybody, Martin. Yep. Adrian, good. JQ, I can't see JQ, but I'm assuming it's thumbs up. Okay, without any further ado, I will pass on to Henry, who will give a brief introduction and then pass on to Ashok. Over to you, Henry.
Not much of an introduction needed for either of these two gents. Ashok, I'll introduce you first and ask you to sort of lead off. Ashok's background is, well, we know him through Mercer, but also through the New Capital Consensus, which I had the privilege of attending a couple of their events. That's great. And chairs, I think, not just of Mercer, but Sun Life. Is that right, Ashok?
Yep.
And of various fintechs such as Fintistic and or Finstick, I can never say that right, and fair value, eValue, and so on. Yeah. Okay, so that's that, and then somewhere else on this call is my good friend Will Hutton.
Here I am.
Yeah, a tiny little aphorism, but when I was about 35 or something, I found this book from this guy called Will Hutton, which was all about stakeholder, and I gave it to my dad. My dad said, "That's for me," and we worked our way through a series, starting with the stakeholding society and the state we're in, and writing on the wall. And goodness knows, we went through so many. So then he went away out of my life for about 15, 20 years, and suddenly there he is. He was back. So I'm delighted to have him on the pension playpen this morning. Will, I'm going to ask you to speak after Ashok has just introduced himself and spent a little time talking about the newspaper consensus. Are you happy with that, sir?
Yeah, fine.
Okay.
Yes.
All right, Ashok, off you. Let's hear what you've got to say on this.
Well, thank you, Henry, and a delight to be here this evening, this morning, and to actually see so many, faces I've known throughout my career on the call. So that's terrific. A little bit of background to perhaps the New Capital Consensus. Having been in this industry for over 40 years, I've been on all sides of pensions, investment, life insurance, wealth management. What's disturbed me is how the ecosystem within we operate does not support long-term investment. And I view, as an entrepreneur, I view long-term investment as just crucial to the health of the country, for savers, etc., etc. And so a few years ago, together with some colleagues, we set up New Capital Consensus, which is sponsored by Chatham House. It's an apolitical, not-for-profit think tank that brings together policymakers, academia, industry to understand. We're systems architects. So to try and understand through a systems lens why the UK investment system is failing the UK. We don't have a dog in the fight, so we're able to say to government, this is what you should do and this is why you need to do it. And since we launched formally February last year, we've been blown away by the reaction to the work that we've done. So if I'm now going to do something very risky and try and share some slides. Oh, God. Hold on.
I advised against this.
Yeah, I think you were wise in this. Right, how do I share? Right, share. Can you now see those slides?
Yes.
Yeah, providing investment flows.
Because it looks like I'm showing the notes page.
Yeah, we're now on slide 2 of 13.
Hold on, let me go back. How do I get this onto? Sorry, I'm gonna stop sharing that.
We can't see the notes, Ashok. We can only see the slides. It seems to be working.
Oh, right. Then that's good.
And Ashok, it doesn't matter if we see the notes. I mean, you know, it's all Chatham House. Don't worry.
Brilliant. Good. Right. The UK doesn't have the starting point here for us is the UK doesn't have a shortage of money. We actually have the second largest pool of investment capital in the OECD. It's actually 6.1 trillion. And yet we have the worst level of investment in the OECD. And we look to Canadian and Dutch pension funds to support our infrastructure investments. And the key question is, why aren't our existing institutions doing so? So that's really what we're about, is trying to address this. And I'll come back to the whole, behind this is the whole issue of capital pools. But let me give you the punchline, which is the money is in constrained capital pools when it needs to be in unconstrained capital pools. How do we get the money from constrained capital pools and unconstrained capital pools? Let's come back to that. So what do I mean by the investment system? Well, on the left, you've got UK savers. On the right, you've got UK firms. And in between, you've got all the other participants, asset owners, asset managers, capital markets. Now, the fundamental thing to realize is that the real investment that takes place is in UK firms. That's where the primary investment takes place. All the stuff in the middle is intermediation, right? And it is the intermediation process that's really sort of screwed up. So the other thing to realize is that the big flaw in here is asset owners. And it's just a chain. So if one link in the chain is broken, the chain doesn't work. So here it is the asset owners that are broken. And the other thing to also mention about this system is it's well let me sort of carry on, and then I'll sort of cover this. So how do I get into the next slide? Right. So if you look at this system, you see that you have the investment system, and that funds all of our physical systems: transport, energy, health, education, and so on. And the way we fund all of our physical systems influences their impact on the environment. And so how we manage the investment system influences our ability to address societal problems like climate change, intergenerational inequality, leveling up, etc., as well as ensuring that we have good infrastructure, schools, education, etc., etc. Right. And the other thing to remember here is that the profit-making gravitational pull of the investment system is huge and corrupting. So we financialize the water industry. We convert houses into trading assets. We put short-term liquidity and risk management ahead of sustainability and long-term individual and societal outcomes. Right. And the real problem here is the routing of the water. So for some reason, this has stopped.
Click on that thing down the bottom left.
No, it's working, Ashok. We're seeing the build.
Oh, you're getting it, right? Okay, got it.
Yeah, right here. Good. If you take the £6 trillion, it's sending money to the wrong places. So, for example, most of the money that's in the traditional bits with profits, DB, has gone into safe, low-yield bonds and UK gilts, which prioritize capital preservation over wealth creation. Most of the money that is in unit-linked and DC is now invested against the MSCI Global, which directs most of the money to the US. 70% the US. Less than 5% of the total 6 trillion is going to fund what we need in the UK: infrastructure, housing, innovative firms. And when you say, well, why does that happen? We've identified 4 frictions within the system. The first friction is that when you analyze the system in totality, we couldn't find a single incentive to generate returns. We could find lots and lots of incentives to reduce volatility, to reduce cost, reduce liquidity. We couldn't find a single incentive to generate returns. And if you're not generating returns, you're not generating economic growth. And so it's not a surprise our economy is flatlining. And this is partly a response to the GFC, and it's left most of our institutional investors in a lingering defensive position, prioritizing capital preservation over return seeking, which may have been the right thing to do in 2009, but not the right thing to do today. The second problem we have is fragmentation. In theory, we've got 5,000 DB pensions, private sector DB schemes in the UK. Reality, they all behave like one big one. They all invest in the same stuff. They all buy at the same time, sell at the same time. And so that creates systemic risk, as we saw in the LDI crisis. The other point here is that because we've all gravitated to very large asset managers, they don't have the appetite to invest 50 million in a renewable energy venture in Aberdeen. That's not going to move the dial for BlackRock. So what we need are pools of capital that are what we describe the right Goldilocks size, that they're big enough to have the right investment skills, that they can access high quality illiquid investments, but they're small enough that they have an appetite to invest in regional UK investment. The third friction is that with our DC and our unit-linked money, we invest essentially against the MSCI Global. So that comes 70% in the UK to the US, 30% roughly to the Mag 7, and 3.8 to the UK. So we give 5%, over 5% to NVIDIA and Apple, and 3.8 to the entire UK. And what this enables is the Mag 7 to buy fledgling British tech firms at a cheap price. So we're literally paying Americans to take away our future innovators and rockstar businesses, which to me is nuts. And then the fourth thing, and this is a really, really important thing, is that the whole system has become biased towards secondary trading over primary investment. You really need the benchmark for secondary trading for price discovery is 20%. So the ideal system would have 20% secondary trading and 80% primary investment. We have 95.5. It's more like 90, 96, 97, 3, 4. And while secondary investment is important, it is a primary investment that builds real things. It builds jobs, that creates wealth, creates outsized returns, that provides the goods and services that we need. So, some good news. We do like the direction of the government. We think the government is going in the right direction. Value for money, the Pension Schemes Act, Mansion House Accord, Sterling 20, all good stuff and really important stuff. But it's not enough and it's not fast enough. it needs to be more aggressive, and we're hoping that the change in leadership will lead to a more ambitious agenda, and we are working on proposals of things they can do which will really move the dial for UK savers and UK society. What would we like to see? We would like to see a few things here. We'd like to see tax incentives being used to incentivize, not mandate, but to incentivize investment in UK productive assets, UK productive companies. Now, we can have a debate as to what we mean by a UK productive company. The important thing is we need to incentivize investment in UK productive assets. We would like to see value for money move away from cheap to good value and return seeking. At NCC, we've created an effectivity screen, which is forward-looking measures that we think trustees should have to report against. We would like to see a more aggressive approach towards consolidation. Life companies are constrained by Solvency UK. DB pension funds are constrained by the accounting regulations. The DC and unit linked are constrained by daily liquidity requirements. So there are things we can do to reduce daily liquidity requirements. Changing Solvency UK is going to take a long time. But we would like to see us sponsoring pools which can invest in an unconstrained way. For us, the big pools that can invest in an unconstrained way are LTPS funds, super funds, and we think life companies should be able to set up super funds outside the Solvency UK ring fence, which we think Catherine Braddock is open-minded to. She used to be on our advisory panel. We would like to see, we think whilst buyout has a role to play, it de-risks investment far too early, 20 years too early. And if the bulk of the money was to go into super funds, it would give DB pension schemes an extra lease of life. They can invest throughout retirement. They can invest in illiquids because super funds would be not susceptible to DB accounting. And it could actually really help to jet propel UK growth, and we've ideas we're working up which we'll be submitting to the government in the next weeks and not very many months as to how we think they can do this. I think key to this, to get the life companies on side, because it killed super funds the first time around, is to allow life companies to set up super funds outside the Solvency UK ring fence.
I have to jump in here and remind you that there is another type of pension which is getting the grip, and that's the CDC pension, which is unconstrained in any way.
Absolutely, Henry, and I'm glad you said that, because we are big fans of CDC and think that is definitely a way forward, an important way forward. And so not just turning, but there's one important friction which I just want to mention, which is risk. And because even if we have perfect consolidation, value frameworks, domestic allocation targets, if we do not tackle risk, and here I mean distinguishing between short-term risk and long-term risk, we will not address the problem. And pension savings are by their very nature long-term. A 30-year-old has a 30-year investment horizon. That's patient capital. It can tolerate short-term volatility in exchange for long-term returns, exactly the sort of capital that infrastructure projects need, long development cycles, illiquid characteristics, strong long run-on fundamentals. But our accounting and regulatory frameworks take that patient capital and put it through the blades of daily pricing and short-term market-based risk management and transforms it into impatient capital. it shreds a 30-year time horizon into 11,001 day horizon. And that disadvantage is precisely the sort of patient investment we need. So our investment system is only fit to dig 11,000 individual holes, not to build new reservoirs. And maybe that's why the last New English reservoir was opened 35 years ago. Now, we're not arguing for more risk, we're arguing for better risk management, distinguishing between short-term and long-term risk. Because a 20-year investor is fundamentally different from somebody who needs to liquidate tomorrow, and we shouldn't treat both as the same. So the vision that we have is I don't know how I get the slide up. Sorry, which slide are you seeing?
12.
Right. Well, right. This is a vision. We have our 6 trillion of UK money is helping to fund the UK and the rest of the world and emerging markets, but with more of a balance to the UK to support UK infrastructure, to support our physical systems, to generate good returns for savers. And we think the right benchmark is not the MSCI Global. We think it's people like the Maple 8, whatever. And I sit on the board of Canadian Life Insurer. I see how they do it. It is so much better than we do today. And we're existing to try and build that consensus. We think this is all doable. There are a number of doable policy steps that the government can affect if it's prepared, if it has the right appetite and understanding, and that's what we're there to help support them, whatever party they are, support them in trying to achieve this vision. So the pipes exist, the resources are there, we just need to point them in the right direction and let the money flow. Thank you.
Thanks very much, Ashok. That's great. Cheers and thanks. Will, I now leave you with the thankless task of commenting on that and then developing your ideas around it, if you may, without in any way denigrating Ashok. I think we need two sides to this same coin.
How do I share the slides?
I'm not going to share the slides now. I'm going to speak for.
Still sharing the sides, Ashok.
How do I get
Ashok, before we move on, can we ask Terry to comment because he's got his hand raised? Terry, do you want to come in before we move on to Will?
Yes, sorry, but because I might have to jump off, I just, as usual, I get sparked into this. So when I'm listening to a lot of the things you've said there, Ashok, I agree with. I find myself nodding at. The bit that concerns me is it seems like there's a more detailed discussion about DB, which for most workers in the UK has disappeared. Okay, so unless you work in the public sector, then there are no DB schemes, and even some of them are close to new entrants. It seems to me what's done so much damage to working people's concept of a pension is DC, which isn't a pension, it's a savings scheme. And I cannot, don't forget that's every individual, this is how it's supposed to work, is in charge of their own investment and can make a strategic investment strategy decision. For those insurance companies making millions, in my humble opinion, they don't need, why would they take any risk? Why would they? As long as they produce, even though what they're producing is inadequate, how do you move? So someone needs to attack is a horrible word, but really challenge and lobby against this concept of DC. It's producing inadequate pensions, and there's no way them insurance companies are going to take any risk. Why should they? They don't need to, do they? They're making their money regardless of the inadequacy of what they're producing for working people. There needs to be stronger language. If there's a strategy on pensions, someone's got to start speaking really strongly about the fact that a DC scheme is not a pension, and we need to get back to proper pensions with long-term aims and long-term investment.
Thank you, Terry, and may that be your cue, Will.
Well, gosh, thank you, Ashok. Lots to say. I mean, actually, just that last intervention from Terry was something I was going to say as well. I mean, as I watched the slides going through, I thought, God, You mentioned my book, The State We're In, I wrote 30 years ago. And of course, I mean, my focus in The State We're In was on the British savings and investment system and how it was dysfunctional. And dysfunctional before the great financial crisis. I mean, you know, the multiplicity of owners, the ownerless corporation, endemic short-termism, risk aversion. These were features of the British system in the 80s and the 90s. I mean, to imagine it was like a golden age or even a better age before the great financial crisis, I think, wrong. I mean, this is very deep roots. An historical digression for 30 seconds, and then back to the kind of today. I mean, I do think that this problem is very deep rooted in Britain's kind of economic history. I mean, one of the problems of being the first country to industrialize and do it spontaneously was we never had to answer the question, how do you marshal resources to kind of put into frontier technologies and kind of commercialize the advantages of science? It all seemed to happen spontaneously. And so much of the kind of British kind of legal system, definitions of fiduciary duty, in one example, behaviours about actually kind of having zero home bias compared with almost every other country actually. No country has kind of less home bias than us. That's again a legacy of kind of investing in empire. I mean, in the state we're in, I do quote Lord Baring in kind of 1905, 1906, saying when challenged at how for the last 30 years Barings had put all their money in Latin America, he said, well, why would I want to invest in Britain? You know, why would I want to invest in Britain? You know, it's just, you know, kind of low return industry. I can make fantastic returns in Latin America. I'm doing the best for the bank and my shareholders. And that's a very, very deep culture. I mean, it's the Treasury in the mid 1930s saying that the best defense against Nazism was free trade and sound money, certainly not investing in our defense kind of capacities. I mean, it's a very, very deep thing. And actually changing it requires some careful thought, actually, about how. And one of the encouraging things about today, actually, is that there's a kind of minority I know, but there's people like Henry with his pension fund, there's you, Ashok, doing what you're doing. There's venture capitalists who are saying, you know, why am I making all this money for Canadians and South Koreans? I mean, you'll hear Saul Klein, who's the most successful venture capitalist outside the United States, kind of bemoaning the fact that you can get the Canadians, the Americans, the South Koreans, the Japanese to kind of invest in him and make fantastic returns. But he hasn't, apart from a little money from Standard Life, little from Schroders, he has no UK money. As part of the picture that you paint. So there is a kind of, and he's finding purchase, you know, in the Council for Science and Technology, increasing people in the city. That's why you have people signing up for the Mansion House Accords. Although, as he would say, you know, they've signed up for it, but they've done very little delivery. I mean, the amount of investment that's gone. I saw some numbers recently. Not one of the Mansion House Accord signatories has made more than one investment in UK scale-ups and since signing the accords. It's desperately slow, and so all of that, you know, to take that kind of, you know, you just have to, in a discussion like this, you know, and I'm an old man now, in my mid-70s, you know, and I've been round the track. I mean, this is not new. It's very, very deep roots, and we have to think about how we're going to migrate kind of a lot of our institutional behaviours, attitudes, and legal structures, kind of so they point in the direction of value creation. And I entirely agree with you. I also agree with you that the government has made some useful steps, but they're useful steps. They're not it. I do agree with Terry that actually, I mean, DB schemes, 1.3 trillion of them. It was very important that you may have all noticed that Michelle Osterman, who was the chief executive of the Pension Protection Fund, resigned 2 months ago. Why did she resign? She resigned because she thought she was going to be allowed by the government to consolidate some of the weaker kind of PPF funds proactively, DB schemes proactively, kind of into the PPF and turn it into a Canadian type super fund, and actually of course, a proportion of the assets would have to be held in safe assets for, you know, to pay the promised pensions. But there was an enormous scope, she felt, to invest in growth equity, publicly quoted companies, kind of infrastructure and property, and actually kind of in private markets. She got zero backing from the government, zero backing from her board, so she resigned. And the insurance industry was protecting its secret garden, 1.3 trillion pounds worth of assets in DB, where actually it takes out funds, crystallizes the liabilities and buys assets, government bonds and corporate bonds, and that's it. And that remains protected. An immense lobby kind of insists on that. And it must remain protected. And the private markets can do, and private actors in private markets will do better for the state, the public, the common weal, and for pensioners than kind of any attempt to consolidate DB pension schemes into a PPF or master DB funds who could take a more enlightened attitude towards risk. It's not profitable. So yeah.
Can I just jump in very quickly? Michelle Osterman actually wanted to be on at this meeting. She sends her apologies. But one thing I did want to ask you historically is how come we had such high allocations to UK equities in particular in the late 20th century? I'm talking about 1970 onwards.
The problem was not the allocations, but it was that the average UK publicly quoted company, and I was now writing this in 1995, 30 years ago, they'd have at least 200 institutional investors. And actually you can't build trust relationships or engage relationships or relationships of commitment with such a vast kind of multiplicity of pension of investors. We've got no tradition of having anchor shareholders, block holders, all the structures, even the Americans have, for permitting a kind of leadership team in a publicly quoted company to kind of engage with a critical mass of, say, 6, 7 block holders. Just doesn't exist in Britain and hasn't existed since the 1950s. So yes, we were investing in equity, but the character of the investment was not very helpful. In fact, the cost of capital of trying to assuage a lot of disengaged shareholders back in the 1990s, was kind of measurably, significantly higher than kind of comparable OECD countries. And Andy Haldane, who was at the Bank of England, some of the data I used in the state we're in was a result of surveys undertaken by the bank. And the bank was advised it was unhelpful to produce such data because it helped critics like Will Hutton demonstrate that ownership structures lead to higher cost of capital. No, but I'm a veteran of this, and it's worth putting it on the table. How long will I be around to say these kind of things? I don't know. So, I think there is some hope, I think, in what's happening in the world of venture capital and the attempts by venture capitalists and by some investment institutions to promote kind of, we have the third biggest venture capital industry in the world, but it's almost entirely American. We need to build up a kind of a UK VC industry with, long-term pension funds money. Some of that 6 trillion, and the flow as much as the stock should be going into kind of fund of funds, maybe funds led by the British Business Bank, and actually, good brains and some clever, smart folk in both the bank and the treasury are kind of getting interested in this agenda in a way they would never have done 30 years ago. The Mansion House, of course, would have been impossible in 1995. It would be seen as anti-business and curtailing the freedoms of investors to invest wherever they liked in the world. So there is movement. And the fact, Ashok, that you're getting the kind of interest in what you're saying is, I think, kind of proof positive of that, which means that, that we've really, I think, got to kind of engage these arguments and get them right, and marshal resource to go into value generation and that missing element. I'm not sure I would excuse asset owners in quite the way you do. I think, or asset managers. I think there's a kind of, many pension funds, are either underpaid or pro bono trustees kind of, giving a fraction of their working week to thinking about kind of asset allocation, are very much beholden to the advice of, advisors and consultants. And that's a whole lot kind of money tree, actually, which a vested interest, and the asset managers themselves are much interested in kind of asset allocation between kind of asset classes geographically than they are behind talking about getting behind a category of value generating firms, tech scale ups, for example. I mean, I find it with my own discussions with my own investment managers, it's kind of, and they concede immediately as I raise it, but they still carry on doing it. So that you've got to, you know, so it's, but that, I mean, you know, I think that, you know, we have to kind of, there is an opening, which you described. I mean, the government is kind of anxious for growth. It's obvious that this is the direction in which you have to travel. And some of the better people in the city are kind of moving this direction, although how sad it was that Schroders had to kind of, which wasn't what, at the more enlightened end of the spectrum, has been taken over by, wait for it, an American company. I mean, it's only yesterday that we learned that kind of Comcast is taking over Sky, and what's it, what Castle Head is it? Kind of private credit firm, US private credit, is taking over kind of EasyJet. I mean, it's just, in the work I did, which brought me back onto the field of play on the, I'm going to finish now. I spent the last 18 months working on a trilogy of reports called the Growth Trilogy for the Purposeful Company, backed by 6-7 good institutions, actually looking at. I've always got it in my head that actually the best way to kind of interest the business community in this argument is to demonstrate that mission-driven or purpose-driven business kind of over time delivers higher returns than just being a shareholder value maximization to a kind of disparate, diffuse bunch of institutional shareholders. And I spent some time at the Purposeful Company trying to advocate that and made a little bit of ground getting that written into the corporate governance and stewardship codes, but you know, it's all voluntaristic and you make tiny progress. I wondered whether what was happening in Britain's private markets might be a more fertile area. And there you find, you know, that there's this extraordinary story of nearly 1,000 now, of nearly 1,000 tech scale-ups who've reached kind of the threshold, turnover threshold of $25 million worth of recurrent income, and a smaller proportion within them the turnover threshold of $100 million. Colts are the ones that venture capitalists say are the ones with turnover thresholds at or above $25 million. Thoroughbreds is the language they use for, or nomenclature they use for ones with a threshold of $100 million. So if they have recurrent income of that type and it's been growing at 20% per annum for the last 3 years, these are companies that have staying power, and they're a fantastic national resource, and they're nearly all purpose driven, and they've nearly all got the concentrated ownership that we don't have in the public markets. In other words, that's to say that one venture capitalist or a small group of investors will actually be kind of invested kind of in the founder and her leadership team, and they work coherently and to drive this business model forward. And one of the questions I'm trying to kind of answer in the next phase of work is how can that model of concentrated private ownership, kind of dedicated to value generation, be preserved when you move into the public markets? Everybody wants liquidity, but the kind of excessive demand for liquidity has actually screwed us, I think. So you walk a balance, but so we're recognizing that there's legitimate demands for liquidity. You know, how do you do that? And that's a question I'm trying to answer in the next phase of work. It's really fundamental. And I know the British Business Bank and the National Wealth Fund actually are interested in kind of working with me, you know, on that. So, you know, it's not a, you know, and your kind of work is really supportive actually, Ashok, and that more people kind of, you know, I'm singing from the same hymn sheet, the more we make this point. But remember, I mean, as soon as, you know, anyone argues that there should be, you know, that tax privileges to pension funds should be contingent to, say, having 15% of their global equity portfolio in UK assets to get some home bias. You know, this is regarded as Stalinism. You know, you are regarded as, you know, Joe Stalin was a moderate compared to such a proposition. And you get people like, what's his name, Nunn, who runs the Lloyd's Bank and Scottish Widows, and you get kind of other kind of creatures from the deep lagoon. Well, you know, scream the odds that how dare you suggest that our freedoms to invest in the MSCI index and kind of make, you know, 5, 6, 7% returns real when kind of the Canadians and the Australians make kind of 7, 8, 9 because they invest in private markets and have lots of home bias. How dare you suggest that we should lift our returns by 20 or 30, 40% by investing in the way that you've just argued for, Ashok, because that will reduce our valuable freedoms and it's it's socialism by the back door. And and again, that goes back into deep into Britain's kind of ideological and political and institutional history. That literally they will say these things and think that they're on the side of the angels, and that the kind of presentation that you've made is you are, you may not realize it, but you are actually a dark socialist, and kind of suggesting that British capitalism can behave kind of more productively and orientate itself around value generation. So it's a big battle to be fought. And I put out an X yesterday. I posted on X about Comcast and the end of ITV and the end of EasyJet. Following last week's news, it was who was it last week? It was Tate and Lyle. And we estimate at the personal company that in the private markets, £1 trillion worth of lost economic value, as 1,700 scale-ups have been sold in the last 15 years, largely to the Americans. And I put that estimate to Demis Hassabis recently, and he said, "Look, well, frankly, double it." I mean, what happened at DeepMind alone, it's kind of the best part of it. 15% of that number of 1 trillion, let alone ARM. So, but if we don't, just to finish off, if we don't solve this conundrum, if we don't actually answer the exam questions you put on the table this morning, if we don't actually look for the best kind of fulcrum in which to kind of make progress, and I suggest it's kind of working with the venture capital community and some of the more enlightened kind of pension fund investors to create the kind of fund structures in which pension funds can legitimately invest. And Michelle has got some good ideas about this, actually. That's a very good starting point to kind of getting people to kind of leading this pension fund horse to water. And another, of course, is the Andy Haldane idea. He floated at his British Chamber of Commerce speech 10 days ago, the Field of Dreams speech, where he suggested that tax incentives to pension funds to save in pension funds should be dependent upon meeting a certain proportion of your kind of global asset allocation in UK equity. So we are making headway, and I think that the circumstance in which the country finds itself, I mean, there's no kind of tax and spend or cut taxes and deregulate kind of viable options to get the growth that we all want. This is the only really kind of smart one on the table. And we have fantastic assets on which to build. We've got the tech companies, we've got the universities, we've got the science, we've got the potential infrastructure. And that is a bridgehead, I think, into the kind of larger world that I know Henry would like to see. So I'll stop now. Thank you.
Thank you very much indeed, Will. And you'll be pleased to know you have no less than 6 questions coming from various sources. I'll start with the man who has just said you are meandering, which is always a good way of starting. Cornelius, or Con, as he is known to many of us, or Elspeth, as he is known to this particular group. What have you got to say for yourself?
You're on mute, Con.
Take that flipping.
Sorry, I just wanted to come in. Henry, you asked why in the 90s we had 60% or more in UK equity. Part of the reason was historic. Don't forget that until 79, we had exchange control, and that made investing overseas extremely difficult to achieve. But then through the 80s and the early 90s, we had a situation where investing in UK equity was particularly attractive because we had advanced corporation tax. And in other words, we were getting a tax credit for the taxes paid by a corporation. That made UK equity, relatively speaking, much more attractive than any of the overseas markets, where dividend availability was all from pre-tax income. Now, that, of course, went with Gordon Brown in 1997, since when we've seen a steady decline, although I think the decline was driven more by the accounting and regulatory standards than by the relative attractions of the investment classes. I do have a question for Ashok. I've read the investment paper that you published. And what surprises me, and it's also something which seems to have been passed unmentioned by Will Hutton, and that is, if we're going to talk about investment, then first of all, we're really talking about new investment. That means that buying secondary market equity from another seller is not actually new investment. The new investment comes from what the seller of those does with their money. And if they consume it or hoard it, then there is no new investment going on in the UK. So there's a question of direct investment or the indirect investment that is less efficient. And of course, if you're going to look at this stuff, if I were looking at this stuff, the first thing I would look at is the fiscal multiplier associated with the particular form of investment that I was considering. But neither of you have actually mentioned the fiscal multiplier, either in the paper or in the speech which Will has just provided. And yet that actually tells us how much growth we get for a pound of investment. A multiplier of 1 is one pound of growth for 1 pound of investment. And it appears that many forms of UK investment, for example, in the defence sector, have multipliers where 1 pound of investment produces around £1.50 of growth. So why no mention of fiscal multiplier and those effects?
Guys, because we do have a lot of questions to get through, Colin.
That's done.
Very, very quickly, Will.
What from me?
Or indeed Ashok, whoever wants to have a go at that one. You're on the.
I think it's a helpful contribution to the debate. No question. I think introducing that would reinforce, the argument. I mean, just one point though. I very quickly meander that I am. I mean, I'm a veteran of this, in a different sphere, and people used to say that if only we could remove the incentive to buy houses by mortgage interest tax relief, we would stop the property boom. And I was always suspicious about this. I thought, people don't understand the hard wiring of the British building bank, building society and bank kind of structures that actually just, the MIRAS was helpful, but it wasn't the driver. And actually, I think imagining that, advanced corporation tax was the driver of and exchange controls were the driver of kind of the equity exposure. And once they went, it was likely to go the other way. It's like, again, mistaken. I come back to the point I made when I was kind of chatting earlier. I do think that, the problem was in the 1990s, we may have been investing heavily in UK equity, but it didn't help a company like ICI or GC or all the companies that ended up kind of falling prey to asset strippers, kind of defend themselves or trying to kind of restructure as kind of, which they could have done. They do it with just dismembered. And, because there wasn't a core of shareholders, block holders who were engaged with the management team, driving value generation and answering the exact question of where does ICI GC go next? And that was a fundamental problem in the 1990s. It raised the cost of capital. And actually, you're right to say that ACT and mark-to-market accounting and all the rest of it hasn't helped the case. But actually, I think you have to look deeper into kind of the kind of structures by UK asset owners and asset managers about kind of how they choose to invest. They really
comments coming in along the lines of this is a bit depressing, guys. So can we possibly have a slightly more positive note as we go through? Because we want to get, well, not rich, but we want to get solvent. Most of us have got too little in the way of pensions. Ashok, very quickly, and then I'm going to move on to Bob and John.
Very quickly, a different way of answering your question, of asking your question, Con, is what Kay found a decade ago, which is why do secondary markets not support investment by corporations, and why do corporations distribute so much rather than invest it? And we are doing a piece of work on that at the moment, and be happy to bring the results of this back to this group if you find it of interest.
We will.
I'd love to.
Bob, my dear unverified man. I don't know if you're unverified in a man. One says one was a.
Yeah. Henry, I don't know if you can hear me or not.
Bob Thompson. How are you?
Thompson. Yep.
Yep.
I'm slightly incapacitated. I broke my right arm, so I can't type or anything. So I'm a bit hindered.
I'm very sorry to hear that, Bob. What's your question?
It's not really a question, it's a commentary. But Ashok and Will, everything you've said, you've got a lot of people on this group, particularly John Hamilton, who would be the next person to ask a question.
No, he just pushed off.
Do really want to see pensions actually supporting the growth agenda. Now, the only way you're going to get pension funds, investments advisors, the trustees to invest in long-term patient capital is to actually incentivize those pension fund trustees to go down that direction, which means getting the investment structure, the taxation structure, correct to encourage. And Con just made the comment, if you go back to the 80s and 90s, we had advanced corporation tax on dividends. That was an incentive to invest in equities. We just need to find a way of getting Andy Haldane's Field of Dreams, getting Torsten Bell to actually agree, get whoever's going to replace Rachel Reeves as Chancellor, to find a way of encouraging UK pension funds, be they DB, CDC. DC is a bit more difficult, but CDC has got to be encouraged going forward to actually invest in long-term capital investment in the UK.
Thank you very much, Bob.
Thank you.
John, I have finally got you. So I've told everyone you pushed off, but I didn't see that you're actually number one. So off you go. I'm sorry about that. Are you there, John? Yes, hello.
Which, me?
John Hamilton.
Hi, thanks.
Yes, if that is John, yeah.
I mean, the positive news messaging is at least government regulators and industry types understand there's a sort of critical need for growth, which we've been in denial the last 25 years. Bob's right, I mean, this is not that complicated. Remove the things that inhibit growth. We've got the most onerous pension regulatory regime in the world, which effectively criminalizes, and I know this as a trustee, this is what's influenced my thoughts the last 25 years. We have a regulatory regime which favors de-risking and capital preservation, and in fact used to penalize you for taking investment. We must stop using the industry word of risk. The only people who manage risk are insurers. So, but at least there's an understanding that. So we have a pension regime which still penalizes taking investment. We have the Pension Act 2021, which criminalizes taking risk.
Yeah.
So, I mean, I really appreciate everything Ashok's trying to do, but this is like the Mansion House Reforms 3. It's all good words and we're all going to do our best. If you criminalize the making of investment, okay, it's not going to happen. So we must change the regulatory regime. The really positive thing the last 3, 4, 5 months is a mindset change within the regulatory arena. From speaking to DWP and the TPR, they understand we need growth. Now, of course, they are not in any way minded to support growth. It's not how they think. So we need to remove the things that inhibit growth, and that's regulation. And we need to have more of the things that encourage growth, incentives. ACT was not a tax rebate. It was a fundamental part of our structure, exempt tax. That's our pension structure, okay? And we forgot the middle bit, exempt, that the incomes that you earn in the pension scheme should be exempt. It was just that it was a land grab by the Treasury. So these are not complicated things to fix. Incentivize what you want to happen and stop putting in place which are restrictions. By the way, last thing, mandation is an absolute disaster waiting to happen. We have had 25 years of mandated regulatory pressure to buy gilts, to fund social services and to fund social care, okay? That may or may not be a good thing, but that's not the job of pensions. What we have now is another form of mandation to correct that previous catastrophic error. We are in a catastrophic situation. We can only get out of it through growth. I'm at least comforted that these discussions are happening. I'm slightly depressed by the reference to empire and people who don't agree with us as being from the Blue Lagoon, okay? They're not. It's part of the debate we have. and Torsten Bell continually call people crazies if they don't agree with them. Everyone on this
John,
call,
I'm going to wrap you up now because I've got 3 more people to speak, and I've got 3 minutes in which they can ask their questions. But I love it, and thank you very much for that. Adrian Boulding, my dear CDC friend, how are you?
Thank you. I'm good. Thank you, Henry. 2 great presentations this morning. I was particularly struck by Ashok's slide with the 3 carrots and 1 carrot missing off the end of the stick. No incentive to generate return. And I want to talk quickly on CDC. You know, I work with the academics at Cambridge. We did a big piece of work last year about how will the CDC schemes, the commercial ones, compete against each other. And the conclusion was that the primary ground for competition is going to be the conversion table. How much pension are you giving somebody for each pound of contribution they pay in? And the principal driver as to what gets you a better conversion table is growth on your investments. But it's actually not growth on your investments. It's the growth that you actually thinks you're going to get long term on your investments. And so what I'm wondering is this a good driver, the expected growth that you actually thinks you're going to get? And it's not quite the same as what Ashok wanted, which was to actually achieve returns. I need to get an investment that my actuary thinks is going to get returns. Is that good enough?
Can I stop at that one? I'm going to come back to you, Eugene and Chris. Do you want to comment on that, Ashok, or Will first?
Just a very quick comment. In chatting with one of my Mercer colleagues on this, he was completely aligned with what you're saying. And to reflect comments, EBCs are as much victims of the system and feel as constrained as the system as anyone else. So, but why we think something like an exit tax on gains on DC, if you don't invest enough in UK productive assets, is a good idea, is because then the actuaries would have to reduce their assumptions as to what they think they will get if they don't invest in UK productive assets.
Thank you. Will, you have 30 seconds.
I mean, just to say that was a very telling part of your presentation, Ashok, the lack of any incentive to invest in value-generating investment. I was very taken with it as well. And offline, I'd love to hear what you think those incentives are. By the way, I mean, I'm not just sure. I'm not sure restoring ACT may be part of it, but I'm sure there's deeper things we can think of.
Okay, Chris, do you want to ask your question?
Yes, thanks, Henry. My focus is on the DC, and particularly those post 50. I'm very supportive of the general arguments of both gentlemen in terms of the accumulation phase, but I fundamentally see a problem for those who are approaching and in retirement. Essentially, when you're in retirement, the most important thing is that you have monthly liquidity, ideally not to sell investments, but to actually get a regular income stream, because that's the thing that will give you a stable income in retirement. So I'm very much focused on yield. Yes, that the UK market, for various historic reasons, is higher yielding than just about every other market in the world. But I particularly have been focusing recently on
Chris,
trying
you're going to have
change.
to hurry up because we have got Eugene waiting for some time. Andrea, I'm not going to get to you. Eugene, just ask your question and we may not have a chance to enter it. No? Yeah.
Thank you. I want to ask Ashok Gupta, if I'm not sure, I haven't seen the presentation from the start, but I know that Mercer is a big promoter of total portfolio approach. And if it's possible, I don't know, Henry, to make a longer presentation about this, because I think it's important for pension schemes.
I'll pick up with you on that, Eugene, which we certainly can. Ashok, have you got a comment to make there?
Look, I think it's really important I don't muddy which hat I'm wearing. I'm speaking here with a new capital consensus hat, and I'm not familiar with the particular strategy you describe, Eugene. But so I'm not really, and it would be inappropriate for me to talk here today on behalf of Mercer.
Okay, I'll pick up with that offline, Eugene.
All right, thank you.
Look, guys, we are now past the
witching hour.
It's 07.25, I would like to say thank you to Ashok and Will for what I find has been a really stimulating conversation. Thank you to all the people who have contributed. I'm going to try and save all the contributions and make them available to people. You'll certainly get the video. Before we go, I'd like to do what we traditionally do, which to take a prayer for the East. Let's hope that things can improve eventually in Ukraine. We've been doing that now for 3.5, 4 years. We really need it to happen. Okay, so a prayer for the East. The next meeting is going to be with Joe Cumbo and Tom McPhail. Tom, it's great to see you on here. I've had an apology from Joe. If you can respond to what you've heard today, that would be great. And thanks to everyone who's been on here. It's been a really, really good hour spent. And I'll close there. Yes.
Okay. Thank you, Ashok. Thank you, Will. And
Thank
yeah,
you.
brilliant session. We appreciate your time and input. Thanks everyone for your questions, and enjoy the rest of your week. Come on, England! Come on, England!
Come on, England. Come on, England.
Come on, England. All right. Bye, everyone.
Bye, lovely tweet, Will, by the way. I put it on my blog.
I did get some, the usual reactions, though. What am I talking about? That actually, I'm very struck at when you do a tweet like that, and it's gone very well. Because 250,000 people have kind of looked at it, but I mean most people kind of are happy to kind of endorse it or say, okay, so what should we do? But there's a very kind of vocal minority who say this is completely the wrong direction of travel.
We should have a glass of wine, Will, with Con Keating. That would be a good, interesting lunch, I think. So have a glass of wine with Con Keating.
Yeah, well, do go on Will's tweet if you still do Twitter.
I do X. Yeah, I do X. I'm not. Yeah.
All right.
Just a couple of things. Will, I would love to catch up with you offline and find out more about what you're doing. And
me likewise, Ashok. Yeah. Me likewise. There's a lot, I can learn a lot from you. I know that.
Henry,
we should arrange a lunch. Ashok, let's do a lunch. Why not do a lunch?
That'd be fantastic. It'd be fantastic.
Ashok. What were you going to say, Ashok?
And the other thing is, it'd be great if you could circulate the NCC website to the attendees. So if they want to get our monthly newsletter, they can sign up for that, or just ask them to send me an email, and I'll get them on a mailing list, and or follow us on LinkedIn.
That's great. The other thing I'd like to say, because I haven't read it yet, but which there's a hell of a lot of stuff in, is our chat. Is it going to be possible to save that, Chris and Steve? Are you able to save the chat?
I will try. There's a lot of chat in there. So before I end the meeting, I can copy and paste it maybe into Word or something like that. But I'm sure there might be a doubt. It'll give a summary, but I'm not quite sure it'll give all the detail. But I'll try and copy and paste it, Henry, and see what.
Yeah, I think it's the best feedback because that's the live feedback.
Yeah.
And if you guys, fine. I mean, some of the stuff. I mean, when Adrian, when he speaks, always seems to get straight to the point. That's marvelous. It's lovely to hear so many people. Great.
Yeah.
And maybe we can get next week. Joe and Tom will be fascinating because they'll come straight to your throat. You know what that's like, Will. You had it happen once before.
Yeah.
I'm very happy to respond to some of the comments if that's helpful, Henry.
Is that Peter? Yeah. Sorry, who is that?
Oh, that's me.
Sorry, excuse me.
Yeah.
And welcome, Porrick. I haven't said hello to you. Are you behind that?
I think Porrick's left, but I've just WhatsApped him. So yeah. Okay. Ashok, the slides. Are you happy? Are they confidential, or are you happy to send them to Henry? Or
very happy to send them to Henry. Yeah.
If you can send them to Henry, that'd be great. Yeah.
Are you there? Because I think there was a question from Rebecca Kowalski I want to respond to. And there was something from you, Rebecca. Are you there?
I think Rebecca's gone. Natalia is probably gone as well. Henry, I've managed to copy and paste it. So it's a Word document. I'll send you the Word document.
You're a superstar.
Right, good. Thanks, everyone. Have a good day.
Right.
Cheers, Thank you all very much.
Bye. Bye.
Cheers. Bye. Bye. Bye.